Hello and welcome back to our second video dealing with chapter 1. And in this video we're going to go over cost classification categories. So we're going to be looking at traceability, function, behavior, and decision making. This chapter is extremely important for this course. Everything that we learn in this chapter is actually going to build the foundation for the rest of the course. So we have to know these cost classifications. Um, we're going to go through some PowerPoints. I'm going to discuss the cost classification categories. So you should be able to define these as well as provide examples of some of these cost classification categories. Now, you should have already downloaded your agenda for the week, so you know that the learning objectives deal with being able to identify and define direct cost, indirect cost, manufacturing cost, non-manufacturing cost, variable cost, fixed cost, mixed costs. So you should again have already read the chapter, attempted your study guide, and pulled out those definitions. So we're going to explain them a little more and go through some examples as well. Okay, so the first cost classification category we have deals with traceability. Now, are costs direct costs or are they indirect costs? Well, that all depends. The first thing we need to understand is what are the definitions? Well, direct costs are costs that can be easily and conveniently traced to a specific unit of product. Okay, so as we talk about traceability, I want you to think about the actual parts of a product. Okay, let's say a bicycle. That's the easiest thing, right? I'm sure everybody's familiar with a bicycle, hopefully. I'm sure at some point in time you guys have either ridden a bicycle or seen somebody ride a bicycle, whatever, right? So let's think about the parts that go to a bicycle, okay? And as we're thinking about these parts, I want you to think about the dollar signs that are attached to that actual product, okay? Or that actual component. And if you can envision that, I believe that will help you with this direct and indirect, as well as the costing techniques that we're going to use, or that we're going to see as we progress into the course. So the first thing, if we're talking about direct, the two key characteristics: that cost has to be easily and conveniently traced to a specific unit of a product. Now let's think about the bicycle. Okay, what goes into making a bicycle? Hopefully you're thinking about it, and hopefully you're envisioning a bicycle and you're saying, well, there's the wheels, there's the pedals, there's the seat, there's the sprockets, there's the chain, right? Those are what we call direct materials, okay? Direct materials become a final component of the unit, okay? So those wheels, those rims, that seat, those sprockets, that chain, it all costs money, right? We have to buy it from somebody, from a supplier. We then take that and assemble a bicycle. We use all those parts, put them together, make a bicycle. Those are all direct costs, okay? Direct labor. Think of direct labor as touch labor. What do you mean by touch labor? These are the guys and the gals that actually assemble a product or that actually provide a service, okay? So let's think about making a bicycle, right? We have the wheels and we have the frame of the bicycle, right? Those are two direct material costs. Why? Because we can easily trace the cost of each wheel to a unit to a bike. We can easily trace the cost of a frame to each unit of a bike, okay? Well, we got to attach those wheels to the frame. How do we do that? Well, we add labor, direct labor. These are the people that actually fasten the wheel to the frame of the bike, that actually fasten the sprockets to the bike and actually put the chain on the bike. Okay, we can easily and conveniently trace direct labor, that touch labor, to a specific unit of a product. Okay, we'll get into the nuts and the bolts of how to do that in a little bit. Right now, all you have to be able to understand is this concept of being able to trace those costs. Okay, indirect costs are costs that are not easily and conveniently traced to a specific unit or a product. Okay, let me give you an example. Any indirect costs are indirect materials, indirect labor, or any common costs. Let me give you an example. Okay, we have our wheels at a workstation with the bicycle frame, and we have all the nuts and the bolts and everything. We have the direct labor there actually fastening all those parts to the frame, but that person needs to use tools, a wrench, maybe a socket set. Okay, those are ideas of those are common costs, right? We had to buy those tools in order to assemble a bike. Can we easily and conveniently trace the cost of that tool to each bike? No way. Not easily and conveniently, right? So we buy a socket set, right? That socket set is used to make, I don't know, maybe 1,000,000 bikes, okay? We cannot easily and conveniently trace the cost of that, wrench and socket set to each bike. That's an example of a common cost. Those are indirect. Let's think about indirect materials. Indirect material costs are costs that cannot easily and conveniently be traced to a specific unit of a product. Now let's just say, for example, that once we put the bike chain on the sprockets, we need to oil the chain. Okay, that oil is technically a direct material, right? Can we easily and conveniently trace the cost of that oil to each bike? No way. Not easily and conveniently. Okay? In theory, we can trace any cost to anything, right? We can come up with a formula, how we want to break down the cost and spread it over each unit. The question to ask yourself is, can it be done easily and conveniently? If the answer is no, it's an indirect cost. Okay? So again, examples of indirect costs are the indirect materials, indirect labor, those common costs like costs for tools, machinery, things like that. Examples of indirect labor would be the production manager. Okay, production manager stands behind the line and he's watching his or her employees making the bicycles. Can we easily and conveniently trace the salary of that product or that supervisor to each unit of a bike? No, not easily and conveniently. Technically we could in theory, but we can't do it easily and conveniently. We're saying it's an indirect cost. Okay, now we got to look at functions. Okay, how do cost functions? Well, there's manufacturing versus non-manufacturing. Okay, what are my manufacturing costs? Well, my manufacturing costs are my raw materials, my direct materials, my direct labor, and my manufacturing overhead. My manufacturing overhead is all my indirect costs. Okay, and we're going to see when we get into the job order costing how we handle this manufacturing overhead. Right now, we just need to be able to identify the classifications and the terms that go into the classifications. Okay, so what I want you to do in another thing here is kind of think of this cost classification as an umbrella. And underneath that umbrella, traceability, function, behavior, and decision making. Okay, we're going to come up with some costs, just like we noticed, direct and indirect costs, right? That's the category. Well, we know that direct material and direct labor are direct costs, we know that the indirect costs are indirect material, indirect labor, and common costs. Okay, these costs, based on traceability, fit into one category. These same costs, based on another category or based on another classification, will fit into another category. Okay, let me show you what I mean by that, and I kind of started to talk about it. Manufacturing versus non-manufacturing deals with function. Direct material, direct labor, manufacturing overhead, right? If we're classifying them based on function, they're manufacturing costs. If we're classifying them based on traceability, well, we got to break them out, right? Those indirect costs, those common costs, are indirect. The direct costs, obviously, are direct costs, okay? Non-manufacturing costs, these are selling and administrative costs, okay? Can non-manufacturing costs be direct and indirect? Sure, they could. They definitely could, okay? So the point is, these terms aren't exclusive, right? The units, that's a bad term, the items that we're putting into these functions or these traceability categories, they're all going to be the same, okay? So let's look at manufacturing costs, but let's look at it from a different angle. Manufacturing costs can actually be separated into prime cost and conversion costs. Okay, what are prime costs? Prime costs are the direct material and the direct labor. These are the prime costs that we need to take our direct materials or our raw materials and turn them into a finished goods, right? Then what we have are called conversion costs. Conversion costs are the direct labor and the manufacturing overhead. These are the costs that we incur to actually convert that direct material, raw material, into the finished product. If you notice, direct labor is both a prime cost and a conversion cost. Okay? So let's look at costs for financial reporting purposes. For financial reporting purposes, we use the classification as either being a product cost or a period cost. Guess what? All my product costs are my manufacturing costs. Direct material, direct labor, manufacturing overhead. Okay? When we're talking about product costs, and we'll get into this in a lot more detail when we get into chapter 2, we have inventoriable costs. Inventoriable costs, which are product costs, these sit on the balance sheet. We do not recognize these costs as expenses until we actually make the sale. Okay, so we have inventoriable costs. Those costs that sit in inventory sit in one of two accounts: work in process or finished goods. Okay, finished goods means the goods actually completed, right? It's ready to be sold. It's been assembled, packaged, sitting on a shelf, ready for a customer to come buy it. Work in process or WIP inventory account is, think of it as a bucket. It's a holding bucket that holds all the costs as well as the inventory of units that are partially completed, right? We have a bunch of bikes. Let me rephrase that. We have a bunch of half assembled bikes. They sit in our WIP inventory account. They might have the wheels and the sprockets attached to the frames, but we still need to add more direct material, more direct labor, more manufacturing overhead to actually complete those bikes. So we got to put on the reflectors and the seat and the handlebars and the brakes. Okay. Period costs, those are our selling and administrative costs. We call those, we can refer to those as SG&A costs or S&A costs. Okay. Period costs are always expensed when incurred. Okay. So let's think about our selling costs and our administrative costs. Well, the cost of the CEO, right? That's a period cost. That's a non-manufacturing cost. The sales force, the commission that we pay, the packaging, the marketing, to sell these products. Those are called period costs for financial statement purposes. We recognize them when they are incurred. For manufacturing costs, those selling and administrative costs, those are considered non-manufacturing costs. So again, the marketing cost, the selling cost, the cost or the salary we pay to the CEO, those are all non-manufacturing costs under function. Now let's look at cost of behavior, right? We have a classification category called behavior. We have three types of behaviors: variable, fixed, and mixed. This is very important, okay? How do these costs behave? Well, variable costs on a per unit basis remain constant. In total, variable costs change in direct proportion to changes in levels of activity. What does that mean? Okay. We have a variable cost, and let's just say, no, we have, let's use our material, direct materials, okay? We have a direct material cost of a wheel, right? Under traceability, it's a direct cost. Why? We can easily and conveniently trace the cost of that wheel to each bike. When we're looking at it from a function point of view, well, the direct material is a manufacturing cost. When we look at it based on financial statement purposes, that direct material, or DM, is actually a product cost. Now we need to classify this wheel as being variable, mixed, or fixed. Well, I'm going to tell you right now it's fixed, or excuse me, scratch that, it's variable. It's a variable cost. Why? Because on a per unit basis, the cost of each wheel remains the same. Okay? Let's just say, for example, it's $5. Okay? One wheel costs $5. I put two wheels on a bike. So that means the cost is $10 per bike. Okay? With me so far? So on a per unit basis, those wheels remain the same, $5, $5, $5, $5. However, in total, the direct material cost in total increases in direct proportion to changes in levels of activity. Okay? If I make one bike, what's the total direct material cost of wheels? Well, 2 times 5 is $10. If I make two bikes, what is the total direct material cost of wheels? Well, $5 a piece times 2, that's $10, times 2 bikes, it's $20. Let's say I make 4 bikes, okay? Per unit basis, those wheels stay the same, right? $5 per unit per bike. So I make 4 bikes. Okay, what's my total direct material cost? Well, because it behaves in a variable fashion, it's in total, it's going to change in direct proportion to changes in levels of activity. So $5 times 2, because 2 wheels on a bike, that's $10. $10 per bike. Now I'm making 4 bikes. That means my total direct material cost is $40. Okay? Fixed costs. Fixed costs remain constant. Okay? They do not change as long as we're within the relevant range. Well, let me explain that a little further, right? When we look at fixed costs, if we look at fixed costs on a per unit basis, they have an inverse relationship to changes in levels of activity, meaning the fixed cost on a per unit basis decreases as activity levels go up. However, in total, they remain constant as long as we're within that relevant range. Okay? Let me give you an example. Now, I always use this example, and I always have some smartass that says, I have unlimited minutes on my cell phone. But for the sake of this argument, let's say that you do not have unlimited minutes. Okay? Let's say, for example, that your cell phone bill costs you $100 a month. Okay, $100. If you make 0 calls, you still have to pay $100. Okay, that's just the luxury of having a phone and being able to make a phone call whenever you want. Okay, and let's say that you get, for that $100, you get 100 minutes. Okay, now if you make 1 call, how much does that 1 call cost you? Well, it costs you $100. Okay, what if you make 2 calls? And let's assume that each call is a minute long. If I make a 2-minute call, it's going to cost me $50 per call. Okay, what if I make a 4-minute call? Well, think about it. 4 minutes divided by the total of $100 gives me $25. That means on a per unit basis, each minute is going to cost you $25. Okay, as we go through and we start doing these costing techniques, we will never look at a fixed cost on a per unit basis. Okay, why? Because it gives the impression that we can change our fixed costs. We cannot change our fixed costs, right? In total, as long as they're within the relevant range, they remain constant. They remain the same. Okay, and the book discusses the different types of fixed costs, and there is a difference in the fixed costs, meaning sometimes they can be changed. It all depends if it's in the long run or if it is in the short run, right? All depends. So if we're looking at fixed costs and we're looking at let's say our marketing, right? Our marketing funds. Those can be discretionary costs, right? These are manageable fixed costs, meaning usually these types of decisions, how much should we spend on marketing? Usually those are made on a yearly basis, so from year to year those can be changed, okay? Committed fixed costs represent an investment in the organization, okay? And think of things like equipment, production equipment. Those are committed fixed costs, okay? We cannot significantly reduce the cost of machinery over the short run, okay? We can over the long run, but in the short run, we can't. So think of committed fixed cost more as an investment in the organization, and it has, kind of like a multi-year time frame, okay? Discretionary fixed costs. These are managed fixed costs. These come up basically on an annual basis of, hey, we can spend a certain amount on marketing. Okay, how much are we going to spend? When we're talking about mixed cost, the mixed costs have an element of variable and have an element of a fixed cost. So let's look at mixed costs and how do we actually calculate what the mixed cost is. Well, first thing we need to know is we need to know the equation. There's an actual very simple equation that we can use in order to calculate what is the total mixed cost. We can also use this same equation to figure out what our total fixed cost is. Okay? So think about it this way. A cost of a bike or a shoe or a glass or a car, whatever, it has a total cost. That cost is almost always going to be made up of a fixed portion and a variable portion. Okay, we're always going to have a mixture of the two. So how do we figure out what our total cost is or our total mixed cost is? That's easy. We use y equals a plus b times x. Y is the total mixed cost. A is our total fixed cost. B is the variable cost per unit. And X is the activity level. So let's say, for example, that we have a utility bill. Utility bills are always going to be mixed. They're going to be made up of mixed costs. Why? Well, because they're always going to charge you some flat rate. That flat rate is just for the luxury of walking over and flipping a switch or turning a dial and getting water and electricity. Okay, so let's say, for example, that the electric bill has a flat rate of $25 plus 3 cents per kilowatt hour that we use. Okay, now let's say that for the month of December we use 300 kilowatt hours. We got to figure out what is our total cost of electricity. Very simple. We use our equation, y equals a plus b of x. We know what each of those letters mean. In the problem, we have the dollar amount that is associated with each of those letters. All we got to do is plug and chug. Y total cost equals $25, which is the total fixed cost for the month, plus 3 cents, which is the variable cost per unit, times X. X is the 300 kilowatt hours that we use. That's the activity. So we see that the total cost of the electricity bill is only $34. The last cost classification that we have is we can classify costs based on decisions, right? So we have differential costs, we have differential revenues, we have sunk costs, we have opportunity costs. Differential costs and revenues, they can either be incremental or decremental, okay? Meaning, we have two decisions to make. The costs are going to differ between each decision, okay? Those are important costs. Revenues, differential revenues. If we do this, we're going to make X. If we do that, we're going to make Y. There's a different amount of revenue that we could possibly earn based on each of the scenarios, okay? Sunk costs. Sunk costs are never, ever, ever included in the decision-making process. Remember, the book tells you that the sunk cost is a cost that has already been incurred and that the sunk cost cannot be changed by any decision, whether it's made now or at some time in the future. We cannot change a sunk cost. Let me give you an example. Let's say I hit the Powerball. I think it's up to 230 million. And I want to buy a Ferrari, right? Or let me rephrase that. I have a choice. I want to buy a sports car. I can either get a Ferrari or I can get a Corvette, right? There's differential costs there, right? Because each cost differs based on which car I get, okay? The fact that I paid, I don't know, like $18,000 for a Ford Focus 3 years ago has no basis now on my decision to buy a Ferrari or a Corvette, okay? That $18,000 that I paid for that Ford Focus is a sunk cost. It already happened. It doesn't matter what decision I make now. Should I buy a Corvette? Should I buy a Ferrari? Doesn't matter. I still paid that 18 grand for that Ford Focus. I can't get that $18,000 back. It's a sunk cost. It already happened. I can't change it. Okay. Opportunity cost. I'm going to go ahead and assume everybody pretty much had a great understanding of what opportunity cost was last semester. But opportunity cost is the cost we give up. It's what we give up to get something. Okay. So think about it this way. When you're saying what's your opportunity cost, you need to think, well, what am I giving up to get this item or this whatever? Okay. I hit the Powerball. What's my opportunity cost of buying a Ferrari? What am I giving up? Well, I'm giving up two things. I'm giving up the money that I have. I'm also giving up the fact that I could buy a Corvette, right? Maybe I'm giving in an opportunity cost in a scenario would be anything else I'm giving up to get this Ferrari. Maybe I want to buy a vacation home down south. That's my opportunity cost for buying the Ferrari. Maybe I want to pay off my student debt. That's the opportunity cost of me buying a Ferrari. Okay, so think about it this way, and I'm going to ask you this. This is an online course, so we are separated by both distance and time. So what is your opportunity cost for sitting down and watching this video? What's whatever else you could be doing, right? Maybe it's sleeping. Maybe it's spending time with your family. Maybe it's laundry. Um, Maybe it's playing video games. I don't know. Whatever you like to do, whatever you're giving up to sit here and watch this, that's your opportunity cost. Okay? So, as a quick review, what are the four cost category classifications? Well, hopefully you said, well, we have traceability, behavior, decision making, and what else? Function, right? Um, so so we have, let's just go back through real quick. We have behavior, financial reporting purposes, function, and traceability. So what's the difference between direct costs and indirect costs? Well, remember, it all has to do with easily and convenient. Direct costs are easily and conveniently traced to a specific unit of a product. Indirect costs are not easily and conveniently traced to a specific unit of a product. What do variable or how do variable costs differ from fixed costs? Well, we need to go back and we need to make sure that we know the two definitions that we have here. On a per unit basis, variable costs remain constant. However, in total, they change in direct proportion to changes in levels of activity. Fixed costs. On a per unit basis, they change inversely to changes in levels of activity. In total, they remain constant. Again, as long as we're within that relevant range. Oh, sorry. Um, and what costs make up the product cost? Well, remember, we have our manufacturing, the manufacturing costs, right? All manufacturing costs are product costs. Direct material, direct labor, manufacturing overhead. Okay, so hopefully this video explained a little more about the cost classifications, provided you with some examples. Hopefully you were able to add a little bit more to your study guide. Now, when we come back in our next videos, we have looks like 3 problems that we need to work on. We are going to work on those together. Excuse me, 4 problems. We are going to work on those together. Okay, so tune back in and watch over those. You'll definitely have the correct answers. Again, the expectation is that you hopefully try those on your own at first, but at the end of the day, you will have those correct answers. So, thank you for tuning in, and we will see you in our next video.